Welcome. We'll be talking today about fundraising and endowment resilience, some of the current fundraising and market contexts that are shaping that. I'm David Bass, Senior Director of Research at CAOs. I'm joined by Nikki Krause. She's the Managing Director and Global Head of Client Development at Strategic Investment Group. Prior to joining Strategic, she held various positions at Hurdle Callahan and SEI Investments. Nikki's a real thought leader in governance and endowment management, frequent presenter at CASE, AGB, and NACUBO programs, and one of the authors of NACUBO's book on endowment management. I'm also joined by my colleague Sancho Sequeira. He's a senior research analyst at CASE. He created some of the really valuable and powerful data resources that we'll be sharing with you at the end of this program today. We have a lot to cover. But we do want to take your questions, so please submit questions using the Q&A function. We'll be trying to keep an eye on those and pause throughout and address questions as they come up. If we can't tackle them in the 30 minutes that we have today, we'll try to follow up with you directly after the webinar. I want to start by thanking Strategic Investment Group, which has generously supported this program and the research work that we'll be discussing today. Strategic is an outsourced chief investment officer industry pioneer, providing purpose-built, customized investment solutions to around 27 clients with approximately 23 billion in assets under management. They've been a great partner to CASE and a great partner to a lot of higher education. We really appreciate their support and their participation in the program today. Why should we be thinking about major gift fundraising and endowment now? I'll share some fundraising context. Nikki's going to share some investment and market context. We're both going to share some recommendations for chief advancement officers and boards, and then walk you through some resources that CASE has assembled over the past year that we think will be really valuable in your discussions with leaders, especially board leaders, but also other institution administrators. I'm going to start with some data from CASE's Voluntary Supportive Education Survey. We collected fundraising data from 875 colleges and universities in 2020. I'm also going to share some insights from an analysis of fundraising in the decade following the 2008 financial crisis. We also have some data from CASE surveys conducted in partnership with Strategic and the Association of Governing Boards. Those were sent out to chief advancement officers of colleges and universities, as well as board members of college and university governing boards and foundation boards. So in thinking about fundraising, and particularly fundraising for endowment, it's critical to remember that capital purpose contributions rise and fall in close relationship to the stock market. On this chart, the New York Stock Exchange is charted in dotted blue at the top of the chart. Capital purpose giving, you can see, mirrors that in dotted red right below that. Current operations, in contrast, tend to follow a pattern similar to gross domestic product. If you look at both of those together, giving tracks the economy and markets pretty closely. As a reminder, capital purpose contributions are those that are designated by donors for endowment, property, buildings, equipment, loan funds, a lot of the type of giving that provides financial ballast and sustainability for institutions. Also includes planned gifts, by the way. Overall, capital giving purposes accounted for 40% of giving to colleges and universities in 2020. So it's a big slice of giving to colleges and universities. Over the year, voluntary support has grown in importance as a funding source of both public and private institutions. Overall, voluntary support accounts for an average of 10% of general and educational expenditures. That's, again, based on BSE data. That doesn't even take into account distributions from established endowments. So when you look at current use or current year giving and the distributions from prior year philanthropy, that starts to be a significant income stream for a lot of institutions. 2020 institutions held an average of $60,000 in endowment per student. If you assume a 5% annual distribution, that's about $3,000 per student. That's, again, really significant. Last year, giving designated specifically for endowment accounted for just over a quarter of all giving to colleges and universities. Um, so that's good news, and that's critical, but it also points to a vulnerability given the contingency on market performance for endowment giving. As an example, let's look at how this played out in FY 2020. As a reminder, the markets plummeted drastically in the first quarter of 2020 as the pandemic broke, and had not yet rebounded fully by the end of the fiscal year, June 30th. So the data that we've drawn on captures a little bit of regrowth, but not all of it by a long shot. During that year, overall voluntary support only fell by 2.6% from 2019 to 2020, but giving for endowment was down 16.4%. So this points to a concern in vulnerability and the need to be really scrupulous in stewarding and cultivating endowment donors. While markets recovered really quickly in 2020, by the end of the year they were setting record highs. That is not always the case. This chart shows differences in the rates at which institutions' fundraising recovered after the 2008 financial crisis. 2008 was a really watermark year, a very high year for fundraising for most institutions. It plunged in the years following that. The bars on the left side of this chart show the percentage of institutions of different types that regrew their fundraising to pre-crash highs within 3 years. And it's about 50 to 60% of institutions in all categories, with the one exception of private research doctoral, regrew their fundraising within 3 years. Another half of the story, though, is the bars on the right side of the chart. Those are the percentage of institutions that had regrown their fundraising to 2008 highs within 10 years, so a full decade later. And if you look at that, you'll see that 10% or more of institutions in almost all categories had not fully regrown their fundraising for a decade. We've assembled a lot of really granular data on recovery times for different types of gifts and different sources of gifts, so different types of donors, as well as recovery times for endowment following 2008. My colleague Sancha will show you what that data looks like. It is available in an interactive tool on our website. It can provide some useful insights when you're thinking about and making projections about what your fundraising might look like in the event of a serious crash. Another thing we learned by looking at fundraising in the wake of 2008 was that endowment giving was the slowest category of support to recover. Endowment giving took an average of 6 years to recover to 2008 highs. It was even longer for public masters and private liberal arts institutions. This is important because endowment's a primary driver of endowment growth, and accordingly, the resources available for student financial aid, faculty support, and other endowed purposes. Since we've just closed out the FY 21 fiscal year for most institutions, I want to pause and ask a quick polling question to those of you who are online. I know numbers haven't been finalized, but give us a sense of whether your institution's fundraising held steady, grew or declined by less than 10%, or grew or declined by 10 to 20%, or grew or declined by more than 20%. Just want to get a quick read on what your fundraising looks like. And you can take that poll right now. I'm going to ask Nikki to share some of her perspective for a second while we're getting poll responses about what she's seeing in terms of endowment, year-end endowment returns.
Sure. So far, we're seeing very significant increases. The results are not out yet, but I would not be surprised to see results kind of be greater than, let's say, 28% and higher, strongly depending on the level of equity, risk, and client portfolios. And so an amazing year for endowments in regards to return. And one of the things we'll talk about is spending rates later, but also for those that took special appropriations in the April 1 through June 30th time period, due to some of the significant events of COVID, unfortunately, it cost a lot more to have taken that distribution given the significant returns we've seen. from July 1st till 6/30 this last year.
Okay. Thanks, Nikki.
Sure.
I think this poll, I'm not sure if you can see the results, but it bears out one of the things we were talking about just a few minutes ago. There's a pretty wide distribution in terms of how institutions fundraising has fared from 2020 to 2021. Around a quarter, 20%, excuse me, remain the same. Looks to me like 15% increased by about 10%, 20% increased by 10 to 20%, and 9% increased by 20% or more. So some really great returns there. At the same time, we had a similar proportion, 18%, that decreased by 10% or something less than 10%, and then 15% that decreased by 10, 20, or 20% more. Thanks for running that, Sancho. And I'm going to move on. If you can stop the poll, there we go. Great. All righty, if you will close that down, I'll get back to our discussion. The next slide, I'm going to show you some data from a couple of our surveys outside of the US. In the US, we look at philanthropic funds received, so essentially cash in the bank. For US institutions, as I mentioned, that held pretty steady, down just 2.6%. In the UK, almost no change at all, a little bit of an uptick in Canada in new funds received. In our UK, Canadian, and Australian, New Zealand surveys, we use a measure called new funds committed, as well as the cash measure. That captures the value of pledges up to their full duration of 5 years, in addition to current year gifts. This paints a very different picture. In the UK, new funds committed were down 17%, and in Canada, it was down 20%. That probably points to the fact that a lot of donors were not yet confident in the economy and markets and ready to make a major multi-year commitment. That could be a little bit of bad news for pledge payments going forward. So pledge revenue could be down in the next year or two. It also probably points to an opportunity. There may be donors who have been pausing their major gift giving, who will be ready to give now that they're more confident. And I think we've also been hearing a lot of donors are just sort of waiting to give until they're back on campus, talking with campus leaders in person, talking with fundraisers in person. So it's a really important moment to be engaging with and stewarding your major gift donors, including your endowment donors. We've also heard that a lot of institutions have had extraordinarily luck engaging new alumni in the course of the pandemic. That points to another opportunity, but it also points to the need to really steward those alumni who you've not yet engaged with or have not yet cultivated to the stage of donors. Again, new potential that is, I think, really worth tapping. Some missed opportunities, I think, that institutions are running up against, and some real red flags. When we surveyed board members and advancement leaders about their policies related to underwater endowments, I was really shocked. About 28% of board members didn't know about their policy, and 15% of the board members responded that they did not have a policy. For chief advancement officers, 28%, a quarter of chief advancement officers reported that their institution didn't have a policy for underwater funds. For those who aren't familiar with the jargon, an underwater endowment is one that has fallen in value below the original gift amount. That entails a need for real careful stewardship. In the past, most institutions would have simply suspended spending from that fund. Now, determinations about spending really are a board's fiduciary responsibility. So not having a policy to guide you in the event of an adverse market event, or simply incremental decays in fund value is something that really needs to be on board's radar screen. The white paper that we've developed in partnership with Strategic outlines some guidance on that, and I think Nikki may share some insights on that a little bit later. With this, I'm going to hand it over to Nikki to talk a little bit about the market context.
Great. Thank you, David. It's always a delight to be with you. And we were delighted to support this research because it is so critical for institutions to be building their endowments to withstand these difficult events, certainly like we have lived through with COVID. If you talk about what people are asking about in investment committee meetings today, clearly there's tremendous concern about inflation. And I think concerns on both fronts, both what will it do to my portfolio, but what should I be expecting in my cost base? So as they look at their operating budget and potential changes for the next year, there's no question we're hearing concerns on both sides and looking at various modeling scenarios and looking how this could unfold over the next 12 months, 36 months, etc. In addition, we talked about the very positive returns endowments have experienced in the last 12 months. And really outside of the quarter of the COVID event, since really 2009, we've seen higher than expected total portfolio returns, which is amazing for organizations in building their endowments. But clearly, many organizations looking forward are saying, gosh, will I have those same expected high returns on my portfolio? And how should I be thinking about this? Clearly, fixed income yields are historically very low. Many asset prices have some relationship to fixed income yields. So as a result of that, we're seeing many committees start to ask us, and this is both clients and out in the marketplace as we talk with people, looking at making a decision in the near term, do I accept a return that is potentially lower than my return objective and stay where I am for now in recognition I've had higher than expected returns, or do I need to take more risk in order to get the returns I need for my portfolio? We move forward. The other big thing we've heard a lot about in the last 12 months is the case for endowment and also misunderstanding in some cases about the endowments. We heard from many CFOs over the past 12 months that they were shuffling around and looking for information on how endowments work because many campus communities were saying, gosh, we're experiencing all of this stress from COVID, room and board. Do we need to rebate some of these revenues? And people were concerned and saying, gosh, we have all this money in our endowment. Why can't we just tap into that? So absolutely, it's a great best practice to make sure you're always communicating about the endowment, what it's used for, how it works. So in periods of crisis, that doesn't create additional stress. And then the other piece that I have been intrigued by for my many years of doing this is how important new contributions are to endowment growth. And so I read every annual Yale report from their endowment. It's, I think, required reading for investment committee members. And in their 2010 report, they talk about the Carnegie Science portfolio, which basically started with about the same level of assets as Yale's in 1910. And in 2010, the date of their report, the Carnegie portfolio was $687 million because they hadn't had new contributions, where Yale at that point was $16.7 billion. And the difference was the additional gifts through the development efforts and then the return on that. So it really could not be emphasized enough that we all should be doing all we can do to get the highest returns in our endowment portfolios without question. But fundraising for endowments helps to get the transformational asset growth that many of us are seeking for our institutions. And then in addition, the next page, please. The other thing that we're hearing a lot about is just questions about spending policy. So I mentioned people are concerned about future expected returns. So if I think the expected returns are going to be a bit lower, certainly I need to look at my spending formula to make sure that I'm not going to be eating into the corpus relative to that. So many institutions are saying, gosh, can I get to a lower spending rate to preserve my portfolio in the near term? But at the same time, given some of the other conversations we're hearing, there's clearly high need today. And then I mentioned earlier, special appropriations, those are increasing at a higher rate than I would have ever hoped to have seen. And as I mentioned, there's been major opportunity costs for doing so. So we're encouraging all boards to really try to stay away from that. In addition, other key things we're hearing, if we go to the next page, please. David mentioned we co-authored the book Endowment Management for Higher Education. We're in the midst of updating that for what we've learned from COVID. And so these things are very fresh in my mind, but there's no question that liquidity is extremely important. And we had stress tested, and many institutions stress test their portfolios, and COVID was clearly a stress test. And so making sure you have adequate liquidity so you don't dip into the endowment at the worst possible time is extremely important. We're seeing more and more clients bucket capital into tranches with different risk profiles. So think of it as operating. It's kind of your checking account. You might have a 1 to 3 year horizon portfolio that you're going to need for capital projects, etc. You invest accordingly. And then in some cases, there's a third tranche that's endowment-like, a little less illiquid assets, although sometimes that could go directly into the endowment. And by bucketing the capital into the various tranches, you can pursue a higher returning strategy with the endowment while still being sure your organization has the liquidity you need to meet your near-term obligations. Also, significant developments in regards to diversity and ESG efforts. A lot of conversation about what are we doing, what should our policy be, and what should we be thinking about on our campus. And then the final point, I always want to make the point that institutional memory and preserving a long-term horizon is something we should always be sensitive to doing relative to keeping our institutions in the best possible situations. One of the things that was in the survey in the study that we published is institutions that had maintained consistency in their development teams did better in getting gifts. And so stability is important both for development and is clearly very important in regards to the stewardship of an endowment portfolio.
Thank you, Nikki. We've now got a few minutes for some questions. I did receive a few questions before this session. One of them was, if you're an institution that has not revisited its policy related to underwater endowments for a good while, or do not have a policy, how do you sort of go about building a policy like that? What are the factors you need to take into consideration? You're muted.
Sorry. This is the policy for underwater endowments?
Yes.
So I have not seen a standard policy for underwater endowments, but clearly a couple things we often see is that many cases when you get a new gift, many institutions have developed a policy where they wait a full year before they actually start taking the distributions from a gift to actually give you a little bit more of a cushion, so you alleviate the chances of going underwater. And then in addition, I'm trying to think of the other point, David, we talked about. It completely went out of my head.
One thing I would note is that in the white paper, we list some of the factors that need to be taken into consideration in making a spending decision regarding an underwater fund. And I would say looking at those same exact factors provides a valuable framework for policy development.
Yes.
Another thing I've been hearing about is, while a lot of institutions drew heavily on their endowment in the past year, there were some purposes that simply couldn't be fulfilled.
Yes.
Because the nature of higher ed teaching and practice changed a lot in the past year. How should institutions deal with endowment funds that have been distributed out to units and are accumulating in departmental accounts? no institution wants to go to a donor and say, we'd love to have another endowment gift. By the way, we haven't spent the last one you gave us for 4 years. Should those funds be reinvested in the endowment? Is that an option? Should they be, is it more of a stewardship and communication issue? How would you recommend places think about that?
And you should comment too. You're an expert here. I would suggest that there's a lot of communication between the various departments, the development staff, et cetera, because clearly you want to make sure that you're honoring the donor intent, and that intent is that those dollars be spent. So if there is not a need for the funds any longer with a particular department or particular use, I would encourage you then to potentially go back to the donor and say, can we adjust the stipulations of this gift? Things have changed and perhaps we don't need the funds for the particular original intent, but we could use them for something else.
Another thing too is a lot of institutions that simply distributed on a regular basis have turned it more into a pool so that funds are only distributed at the point at which they are going to actually be spent, allowing them to accumulate in the primary endowment pool for longer. Another thing that we have heard about, and this is a sort of oblique relationship here, we were asking about when institutions do find that their funds are going to be underwater potentially, and I think that could well happen in that fund values are very high right now.
Yes.
Newly created funds could lose a lot of value and go below creation level pretty quickly. As Nikki suggested, one strategy to deal with that is to sort of hold for a year and let them grow and accumulate. A lot of institutions also make a point of going out monitoring funds when something's on the precipice of going underwater, talking with donors and seeing if they would like to make a current use gift to fulfill the purposes of the fund and then let that fund regrow. That's a great way to sustain fund values and not erode them when markets are headed south. We also heard that people had a lot of luck with that. I forget the exact number, but the proportion of donors who were willing to make a supplementary gift was very high. If that's not something your institution does as a matter of course in terms of monitoring funds and having a cultivation and solicitation strategy in place for donors whose funds may be underwater, that's certainly something to think about. I think we're just about out of time now. I'm going to stop the slides and ask my colleague Sancho to share just a few of the resources, and then encourage everybody else to feel free to reach out via email if they have additional questions about that.
All right, bear with me. Can you guys see that now?
There we go.
All right, so this will be on the end of the slideshow, but if you just Google fundraising and endowment resilience and CASE, this should come up. The two resources I'm going to show you are right up here. So they're the red near the top of the page. The first one here is the white paper that David and Nikki have been referencing. I won't go through the whole thing. I'll leave that up to you, but I think it's a really good resource for kind of summarizing a lot of stuff they discussed. In addition, there's this interactive report that's been created, and it breaks down the data in 4 different ways. It shows first year to recovery for a bunch of variables separated, and each of the lines in here are different types of institutions. The next one actually by institution is the type of variables. So it flips that. So for each institution type, it has all of the variables. Then finally, the last 2 kind of sections down here, and you can use the sidebar here to jump to sections. It actually shows the % recovered by category support. So you can look at for total support and these institution types, what's the % of institutions that recovered by a given year. It's really nice because, like I said, it's interactive. When you hover, you can look over all the numbers at once. If you press this little picture thing here, it actually downloads it if you want to pull it into another presentation. Clicking here will remove data points, or double clicking isolates them. If I can do it quick enough. There we go. And then under each of these is actually the raw data, which you can copy out to CSV Excel format. So this is a really nice tool for kind of visually playing with some of this data.
And this was really developed to provide case members and others with a tool to go back and do some thinking about what a major market event looks like in terms of your endowment and fundraising. I think this is a really easy way to pull together some numbers and models for use with boards. Another thing we did not go through in the webinar, but in that white paper, we have a couple of pullouts that I think are really valuable for your board meetings and discussions. One, some recommendations for chief advancement officers. I would actually say those are more broadly recommendations for advancement and thinking about how your institution engages with donors related to endowment and endowment giving. The other is questions that boards should be asking now. As Nikki indicated, the markets are great. It's a really good time to have these conversations. So do look at those. We hope they'll be helpful as you think about your board agendas in the months ahead. With that, we will wrap this up. Also on the webpage that Sancho referenced, our recordings will be a recording of this webinar, slides from this webinar, and recordings of a couple of prior programs that CASE conducted over the past 9 months that bear on these topics. With that, I'm going to say thank you again to Nikki. Thank you to Strategic for their support of this work over the past year. And thanks to you all for joining us.
Thank you.
Thank you.